Morning, everybody, and many thanks for joining this morning's briefing on the Provisional Q1 2021 National Accounts and International Accounts results. We'll be keeping microphones on mute as we go through the presentations on today's results, and we'll take questions at the end of today's presentations. Can I ask people to use the Q&A function at that stage for the questions, but we'll remind you again at the end of the slides. At our recent briefings, you'll have seen the impact of the COVID-19 related restrictions over the quarters of 2020, and you'll see today the restrictions have also had an impact on the results for the first quarter of 2021. My colleagues will take you through the quarter-on-quarter and the year-on-year comparisons in this morning's slides. Just to let you know, the slides from the briefing are available along with the statistical releases on the CSO website, and a recording of today's presentation will be available on CSO's YouTube channel. Of course, users can contact CSO at any stage with queries on the statistics. Contact details are available on all of our statistical releases and on the press release for this morning's briefing. So I'll pass to Chris now, who'll take us through the national accounts results, and then we move on to John after that, who'll take us through the international accounts results. Many thanks.
Thanks, Jennifer. So I have the Q1 2021 national accounts results for you. Very much need to stress that these are provisional results, early results for Q1, and we'll be back in a couple of weeks with updated results based on new weights for 2019 and 2020. But the headlines for Q1 2021 is a very strong result for GDP, up 7.8%. While there's some timing issues as usual with some of the M&E activity across the quarters, we've continued strong production in the pharma sector and in the ICT sectors across perhaps the last four quarters, continuing to Q1 2021. Interestingly, the current price GDP for Q1 2021 is actually just gone over 100 billion. So that's the first time that's happened, and it's, I guess, the first quarter of 2021, and we'll have to see how the year outturn comes for that. When we take the M&E profits out of the data, so a lot of this activity is driven by M&E activity, and we take the M&E profits out of the data, we end up with a GNP result in the quarter of minus 1%. Then with further modifications for globalization, we have our modified domestic demand measure having a result of minus 2.9%. So modified domestic demand as a domestic measure is working very well throughout the pandemic. It shows the fall into Q2, the recovery in Q3, and a small fall in Q4, and again now in Q1 of minus 2.9%. Symmetrically, I guess, on the expenditure side of the accounts, we're seeing that very large growth in net exports to match the output for industry and ICT on the other side of the accounts. We see some increases in government expenditure, as we've seen over the last number of quarters, but the consumption numbers are down, as perhaps expected, down 5.1%. The restrictions increased in January after the what data we saw in the last quarter of 2020. So if we look at GDP over time, we can see that some of the timing issues here, I guess, that we're talking about between the production, the GDP approach, and after the profits flow out, the GNP numbers that are left behind. So we have a GDP result of 7.8% and a GNP result of minus 1% in the quarter. If we compare this data to some of our available peers, we can see Portugal, Germany, Slovakia, and the UK, I guess, out on the left-hand side with falls in Q1, while Estonia, Croatia, and Ireland are perhaps on the other side with moderate to high levels of growth in the quarter. On the output side of the accounts, going through the sectors, the bar shows you the importance of the sector in terms of its size for the economy, and beside each item in the legend is the growth here. So we can see the industry, the big blue part of that bar, is growing at nearly 13%, 12.8%. Then the ICT sector is growing nearly 20%, 19.1%. So the two big multinational dominated sectors of the economy are growing rather quickly in Q1 2021. On the other side, we see some of the smaller sectors, but importantly, domestic sectors, distribution, transport, hotels and restaurants down nearly 10%, and construction down in Q1 when the restrictions increased. We can look at those series over time. If you go on to the publication on the website, you can toggle on and off these series, so you can leave some of the series behind to give perhaps a clearer picture that the ones you're interested in. So for example, here, arts, entertainment and other services are continuing at the low base throughout the pandemic, while we see the distribution, transport, hotels, restaurants and the construction to domestic sectors going up and down as restrictions come in and out. And then we see the M&E dominated industry and ICT sectors with large growth throughout the pandemic. Again, you can see some of the timing issues with the ICT sector, but it's important to stress that both those two M&E dominated sectors have shown substantial growth across the last number of quarters. If we look at some of the CSO's monthly data from our business statistics, we can get kind of confirmation, I guess, of this growth in industry. So we have 3 months of the higher index there for Q1, along with some of the higher growth towards the end of Q4 last year. And we can look at services as well in our monthly services data to show us that when the restrictions increased in January, an example here of accommodation and food services perhaps fell the most. And these are month-on-month changes from some of our high-frequency statistics. We also have the split of M&E and other, or M&E and domestic data available at this point. That's in the publication today as well. And that confirms the result that it's the foreign-dominated data that's driving the GDP result in the quarter. So the foreign dominated sector is up 17.9%, while the other domestic sectors are down 2.1%. And you'll find that this analysis is highly correlated with the modified domestic demand measure on the expenditure side. So if I go to the expenditure side of the accounts, so to get to GDP on the expenditure side, we look at everything we spend in personal consumption, government expenditure, capital formation or investment, as well as net exports. And similarly on the website, we can toggle these series on and off to see how we get to the modified measure, modified domestic demand. So if we take out exports, which was growing nearly over 50% quarter on quarter, and the big fall in investment because of some of the volatility in the data, we can then build up modified domestic demand from personal consumption, the government expenditure, and then to get from the stacked bar to the blue line, modified domestic demand, we just have to put in the modified investment numbers. So that explains the relationship between GDP and our modified domestic demand numbers. So looking at the elements of expenditure in the quarter, consumption down 5.1%, fairly evenly split between goods and services this time. We've seen a number of quarters where services have shown the most impact in terms of personal consumption. And we can see that 3 months ago in the year as results for 2020, and some of the year-on-year comparisons I'll talk about in a moment. But we can also compare the Irish consumption to some of our European peers here too. And the available data at the moment will show us that Germany, Ireland, Norway, this large falls in consumption in the quarter. Again, probably related to the level of restrictions. Similarly, we can look at month-on-month data just to confirm that result from our business statistics, looking at retail sales. And we can see when the restrictions increased at the end of December, we see the falls here in department stores, books, furniture, and clothing. So some moderate clawback on that, I guess, in February and March. These are month-on-month changes. But we can see the big sectors in the services side that were affected in terms of consumption from retail sales. And our retail sales also show us the impact on online sales. So as the restrictions increased again at the end of December, we can see the online sales increase in January, February, March. So this has been a pretty close trend to observe throughout the last 12 months. looking at as restrictions increase, online sales increase for these sectors, and the online sales fall off again as the restrictions decrease. And we can look then over time at the retail sales index. So the monthly retail sales index has charted the pandemic pretty well, and it's helping us explain a big element of our consumption numbers. If I move to investment, capital formation, there's very little we can say because of some of the confidentiality last quarter. The total's down 19.5% in seasonally adjusted constant prices. But I think what we should look at perhaps is the data across time. And we can see that this quarter's numbers are pretty similar to the last couple of quarters. We don't have any large IP like we did in some of the quarters over the last 2 years. Some of the year-on-year comparisons are also difficult because Q1 2020 had a lot of suppression. We can't say that some of the M&E data is up year-on-year, particularly around hardware. If we look at the big element on the expenditure side, net exports, we can see there that goods exports in constant price seasonally adjusted data are up 11.3%. Goods exports of services are down a little. Imports of goods are down a little, but imports of services are down substantially because of the large growth in the previous quarter. So I'll leave the detail on exports to the international accounts with my colleague John. So if we look at the elements of the expenditure side and put them all together to get our modified domestic demand measure, we can then decompose the 7.8% GDP growth rate into the bit that's related to the domestic activity and modified domestic demand, coming out at minus 2.9%, and the elements related to the M&E activity or net exports. So this modified domestic demand measure, as I said, looks pretty good. I think it's charting the pandemic pretty well for us, with a large fall in Q2, the recovery in Q3, and then some falls in Q4 now, again in Q1. To get from GDP then to GNP, there's a notable issue here with large profit outflows. So net factor flows are up again in Q1, as they were in Q3 2020. So we've typically had a very stable series of net factor income, net factor flows over the last number of years. And these 2 quarters with M&E activity, timing of M&E activity have meant large profit or net factor flows, giving us the negative GNP result today of minus 1%. To pause from the seasonally adjusted, the latest data, it's worth at this point just having a look at the 3 months, the first 3 months of 21 compared to the first 3 months of 2020, just to see perhaps a pre-COVID quarter. And we can see here the consumption's down nearly 12%. This is very similar to the annual 2020s, but it's a different piece of analysis. It's just the first 3 months compared to the first 3 months of last year. But it's again confirming the trend that services are taking more of the hit in terms of personal consumption, mainly because of the foreign travel being down and the use of public transport being down. Similarly, on the investment side, we can look at a few more figures here. On Q1 2020, building and construction is down nearly 19%, with new dwellings down a little bit more, 21.1%. Again, some of the other data is suppressed because of some of the activity in Q1 2020. GDP, if we want to take a measure of where we're at for this 3 months versus the level 12 months ago, the first 3 versus 3 months of 2020, GDP is up 11.8% and GNP is up at 2.9%. So I guess it's worth just thinking about that where we are versus before COVID for this 3 months. It's important to stress that that's not an annual result. It's just these 3 months over 3 months last year. And it's perhaps more important to look at the change from one quarter into the next. So I'll finish on that on our seasonally adjusted data, looking from one quarter into the next. So Q1 2021 is up 7.8%, mainly driven by the M&E activity in industry and the ICT sector. Some of the domestic sectors like distribution, transport, hotels and restaurants down nearly 10%. And when we take the profit outflows away from that, up to nearly 28 billion in the quarter, we end up with a GNP growth rate of -1%. And on the expenditure side, we see consumption's down 5.1%. Government expenditure is up a little, as it has been over the last number of quarters. And then we have some of the volatility in investment and net exports. When we strip out that M&E activity on the expenditure side, we come up with a modified domestic demand number, measuring domestic activity of -2.9%. And again, it's worth stressing on that measure is working particularly well throughout the pandemic, showing the fall into Q2, the rise in Q3, and a small fall in domestic activity in Q4, and now again in Q1. So at that point, I'll hand over to my colleague, John Sheridan.
Thank you. So now I'd like to take you through the international accounts preliminary results for Q1 2021. So we'll start with our infographic, which I think gives a good summary of the quarter. So we can see that our goods balance is 43.7 billion, our services balance is 3.7 billion, and our net income outflows are 29 billion, which all combine to give us our current account balance of 18.4 billion, or 18.4% of GDP. So over the next few slides, we'll look at each of these in more detail to try and explain the changes. So to start with our current account balance as a percent of GDP, we can see that we've had now 4 quarters without large imports of IP, and we're getting a much more stable series as opposed to the volatility we saw in the previous quarters. So delving into the components of the current account a bit more, we can see that our current account balance at 18.4 billion is up 33 billion on the same quarter last year. But this is largely driven by the difference in IP imports between the 2 quarters, with large imports in Q1 2020 and low imports in Q1 2021. And we'll see this right through the accounts. Our merchandise surplus stands at 43.7 billion, which is up 9.2 billion on the same quarter last year. And our services balance is 3.7 billion, which is up 31.9 billion on last year. But again, this is driven by the difference in IP. Our net income outflow is 29 billion, which is up 8.1 billion on the same quarter last year. So to look at this balance over time, we can see again the more stable current account series in the last 4 quarters, as opposed to the volatility in the previous quarters. We can see where the volatility occurs is where we have those large negative services balances that are largely driven by IP imports. So comparing this quarter to last quarter, we can see that our merchandise balance is up, our services balance is up, flipping from negative to positive, and our net factor outflow is up. And these all combine to have a current account that's increased by 11 billion on last quarter. So looking into the breakdown again a little bit more, we can see that on the merchandise side, our exports are 68.8 billion, which are up 9.4 billion on the same quarter last year, while our imports at 25.2 billion are almost flat, being up only 121 million on the same quarter last year. So we can see that the increase in the merchandise balance is largely driven by exports. On the services side, our exports are 60.6 billion, which are up 7.9 billion on the same quarter last year. And we look at that in a little more detail later. While on the import side, at 56.8 billion, this is up 24 billion on the same quarter last year. But again, this is largely driven by differences in IP. Looking at our primary income, we can see that the inflows are 29.7 billion, which is up 3.3 billion on the same quarter last year, while our outflows are 57.4 billion, up 11.2 billion on the same quarter last year. Looking at the part of these that are made up by direct investment, profit and interest flows, we can see the inflows there are 10.2 billion, which are up 4.1 billion on the same quarter last year. And this is largely driven by restructuring, while the outflows stand at 36.8 billion, up 13.3 billion. So we can see that the main driver in the increase of the net factor flows is in direct investment. Looking at the goods exports and imports a bit more closely, we can see that our Q1 goods exports are up compared to last quarter and also up compared to the same quarter last year, while our imports are down compared to last quarter and up very slightly compared to the same quarter last year. So again, we can see that the driver of the net merchandise increase is in exports. Looking at how this splits out into international trade and goods for processing, we can see that the international trade exports are up compared to last quarter and down compared to the same quarter last year, while the goods for processing exports are up compared to last quarter and also up compared to the same quarter last year. On the import side, our international trade is down compared to last quarter and down compared to the same quarter last year, while our goods for processing imports are up compared to last quarter and up compared to the same quarter last year. So we can see that the increase in exports is largely driven by the increase in goods for processing. Looking at our services a bit more closely, we can see that the overall increase in exports is 7.9 billion compared to the same quarter last year. And this is largely dominated by the increase in computer services of 6.3 billion. Our tourism services are down 644 million and our transport services are down 923 million compared to the same quarter last year. And this is continuing the effects of COVID. Looking at our business services, we can see that they're down 768 million. And this is largely driven by decreases in operational leasing this quarter. So we can see that our increase in service exports is largely driven by increases in computer services. Looking at the import side of services, we can see that huge decrease in business services of 28.6 billion, which again is driven by the differences in IP between the two quarters. And this gives us our overall decrease of 24 billion. Royalties have increased by 3.7 billion, of which royalties related to pharmaceuticals increased by 317 million. Our tourism services are down 1.1 billion, again continuing the effect of COVID. To look a little more closely at our royalties, we can see that the overall level has reduced again following the large increase last quarter. Just looking at the part of this that is made up by pharmaceuticals, we can see that there is a quarter-on-quarter decrease and there's also a slight increase compared to the same quarter last year. But we can see that the large changes in the last couple of quarters is related to other sectors, of which the main contributor would be ICT. Looking again at our direct investment income, we can see that our inflows stand at 10.2 billion, which is up 4 billion compared to the same quarter last year. And our outflows stand at 36.8 billion, which is up 13.3 billion compared to the same quarter last year. So again, we can see that this combination is the main contributor to the net income outflows increase of 8.1 billion. Looking at how these income outflows split out, we can see that our income on debt is fairly flat as usual. That the main changes are all in income and equity. We've had some large dividends this quarter, resulting in reduced reinvested earnings. And while we normally have more dividends in Q1, they are particularly large this quarter. But overall, you can see that the increase is due to income and equity and is in the combination of dividends and distributed branch profits and reinvested earnings. Looking at the sectoral breakdown of our quarterly profits outflows, we can see that there's been an increase in the manufacturing sector and in the ICT sector. So we can see that both of these are up compared to last quarter and also compared to the same quarter last year. So our increase in net factor outflows is again spread across sectors, but is larger in the manufacturing sector. Looking at our trade income and our current account with the UK, the trade balance with the UK has increased by 2.7 billion and the net income outflows have increased by 1.9 billion compared with the first quarter of 2020. This is partly driven by the decreased imports from the UK in this quarter, with imports down by 1.9 billion compared with the same quarter last year, which has also given us a positive merchandise trade balance with the UK for the first time since Q3 2017. The result is a current account surplus of 3.4 billion in the first quarter of 2021, up 4.9 billion from the deficit of 1.1 billion in the first quarter of 2020. Looking at our financial accounts, we can see that we have increases in direct investment and portfolio investment compared to last quarter and decreases in other investments. But we're still seeing quite low transactions compared to some of the larger quarters previously. And looking at our positions, our international investment position for Q1 2021, while there have been fairly large changes in other financial intermediaries and in non-financial companies due to restructuring, overall, the net international investment position has reduced by 3.6 billion to 611.4 billion since last quarter. So to summarise, we have a current account balance of 18.4 billion or 18.4% of GDP in Q1 2021. We're continuing to see low levels of IP imports, and our COVID-19 effects continue into this quarter, with lower tourism exports and imports largely netting out for the current account and lower transport services exports. So now I'd like to pass over to Jennifer to summarise.
Thanks very much to Chris and John for taking us through the results. Look, just before we move into the Q&A, to draw out the key messages from the results this morning, we have GDP increasing by 7.8% Q1 2021 on Q4 2020. We've explained that that's driven largely by a significant growth in net exports, so an increase in exports, but also a decrease in imports of goods and services, driving that very strong net export result, driving that GDP result as well of 7.8%. Of course, what happens then when you have these strong net exports, you have it generally translates into the strong profits that we're seeing. That's part of the net factor income step between GDP and GNP. So we are seeing that contraction of 1% in GNP in Q1. To move on to to kind of drill down, I suppose, into the more domestic indicators on the economy, and we do try and encourage people to look beyond the GDP and GNP headlines, because to see the more domestic side of the economy, it is important to look at, for instance, the modified domestic demand indicator, which covers government, personal and investment spending, but then removes a lot of the impact of the globalization type investment. And you've seen in the information we provided this morning that over the last years, but particularly in 2020 into 2021, a lot of volatility there in the transactions around intellectual property products. So that modified domestic demand indicator gives us a very consistent view across the quarter of what's happening domestically. And we have a contraction of 2.9% modified domestic demand in Q1. And then just to look at the very much the household component of the modified domestic demand, spending on personal consumption, so what we all spend on goods and services, that's contracted by 5.1% in the quarter, in line with the retail sales information, the monthly information that Chris took us through this morning. Okay, so just to stress again that these are the provisional results for Q1. In the coming weeks, we will have our revised annual series. We'll be publishing our National Income and Expenditure publication. And so we will have revised annual data, and obviously we'll have the revised quarterly data consequential from that as well. And we'll run a webinar again, or a session again, so that people, to take people through those changes and to allow for a Q&A at the end of that session too.